Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
It is a phenomenal morning if you're a bull, but underneath that surface, the forces pulling at the global markets are getting incredibly complex. I mean, we're seeing policy divergence, tech battles, political theater, all at once.
That is exactly what we are here to untangle. Today, our deep dive mission is to synthesize those major movements. We're looking at central bank policy, specifically this crucial split between the U.S. and Japan,
Right.
the intensifying competition in the AI sector, and, some key geopolitical trade developments. We've pulled reports from CNBC, Reuters, Yahoo Finance, and Bloomberg to get you the full picture.
And the immediate context is definitely risk-on.
Yeah.
Asia-Pacific and European markets are they're tracking the Wall Street gains. We saw some major jumps. Japan's Nikkei 225 surged 1.85%.
And South Korea's Kospi was up, what, over 2.5%?
A stunning 2.67%. And even in Europe, the stock 600 climbed about 0.40% in early trading. Everyone's feeling bullish, and that optimism is rooted almost entirely in what they expect from U.S. monetary policy.
And that's the perfect starting point. That optimism is a direct result of one big idea. The Fed is going to cut rates, and soon. Let's really unpack that expectation because it feels like the gravity well for everything else right now.
It truly is. The primary market driver is the rising expectation for a U.S. Federal Reserve interest rate cut in December. I mean, if you look at the CME FedWatch tool, markets are pricing in a nearly 85% chance of a quarter-point cut.
85%. That's not just a possibility, that's a conviction.
It's a conviction. And it's not just speculation. It was bolstered when New York Fed President John Williams endorsed lowering rates in the near term. That's a huge signal from a key official.
And the timeline for this is getting sped up by all the political drama around who will actually be running the Fed. Treasury Secretary Scott Bessent said there's a very good chance President Trump could name a new Fed chair before Christmas.
Which is an incredibly fast timeline. And that decision, well, it's almost certainly driving the current market mood. According to reports, the focus among Trump advisors is on Kevin Hassett as the clear frontrunner.
And the market sees Hassett as much more likely to push for lower rates, right?
Exactly. He's made his views very public. He said last week that if he were Fed chair right now, he would be cutting rates right now because he believes the data supports it.
So what does it mean for the market when a potential Fed leader is that explicit?
It means the market adjusts immediately. You saw it happen in the Treasury market. The news about Hassett caused Treasuries to rally, and it pushed the critical 10-year yield below 4%.
And that 4% number is a big deal.
It's a huge psychological and technical barrier. Breaking below it signals that investors are now definitively pricing in a path of lower rates for the long term. They're moving away from that whole higher for longer narrative.
So the market believes the Fed's trajectory is now locked in by politics, not just data.
That's the narrative shift. The shortlist is tight. You've got Waller, Bowman, Warsh, Hassett, and Rick Ryder from BlackRock. But the money is betting on a dove.
Okay, so that's the gravitational center. U.S. rates are expected to go down. But here's the divergence, the fascinating part. While the U.S. is preparing for cuts, the Bank of Japan is doing the exact opposite.
This is the pivotal macro tension right now. Reuters is reporting that the BOJ is deliberately prepping markets for a rate hike, maybe as early as December or January. This is a huge shift back to hawkish language for them.
Wait, isn't that incredibly risky, hiking rates when the rest of the world, or at least the U.S., might be slowing down? Why do this now?
It's risky, yes, but they're prioritizing their own domestic stability. The main driver is worry over the weak yen. It's slumped to 10-month lows against the dollar.
And they're worried about imported inflation.
Exactly. They're concerned that this weakness is driving up underlying inflation more than in the past. And this time, the political consensus is shifting. They fear inflation more than stagnation.
Which is a huge change. Historically, the political pressure was always to keep rates low.
Right. But now that's fading. The finance minister voiced no particular objection, and even the prime minister seems to be on board with gradual rate hikes.
The BOJ basically has a political green light.
They do, which makes a December hike a real possibility. So you have the world's two largest economies, the U.S. potentially easing because of political will, and Japan tightening because of currency fear. That's going to create some serious volatility.
Absolutely. Okay, let's pivot from central banks to the central nervous system of the economy right now, AI chips. Despite that broader rally, NVIDIA shares actually fell 2.6% on Tuesday. So the crown is looking a little uneasy.
The pressure's coming from two sides, competition and scrutiny. The competitive landscape is heating up fast. Google just released its new AI model, Gemini 3.
And the key part is that it runs on their own chips, right? Their TPUs.
Exactly. Google is self-sourcing. That's the number one. Threat number two is Meta. Reports say Meta is looking into leasing and using Google's custom AI chips for its own data centers as early as 2027.
So two of the biggest potential customers are looking for an off-ramp from NVIDIA.
Potentially, yes. And beyond that competition, the financial scrutiny is intense. Michael Burry, the Big Short guy, he's raised concerns about lofty valuations, about companies overestimating how long NVIDIA's chips will last.
But the really sharp critique is from Jim Chanos, the man who called Enron. He's drawing parallels to Lucent and alleging circular financing. Can you break that down? What does circular financing mean here?
Sure, it's a crucial concept. The argument from Chanos is that NVIDIA is essentially using its own money to support its biggest customers. He points out that NVIDIA has invested heavily in companies that are losing money, think OpenAI, xAI, CoreWeave.
Okay.
And then that investment money flows right back to NVIDIA as revenue when those same customers use it to buy NVIDIA chips.
So if I'm hearing this right, he's saying NVIDIA is basically lending money to its own customers so they can turn around and buy NVIDIA's product.
Yeah.
It makes the revenue look amazing, but the health of the transaction is iffy.
That's the argument, exactly. It raises the question, where is the real economic transaction? Chanos calls it putting arcane financial structures on top of these money-losing entities, and he thinks it's the Achilles heel of the whole AI market.
And NVIDIA, of course, is fighting back hard.
Very hard. They issued a private memo, posts on X, disputing all of it. They say their business is sound, their reporting is transparent, and critically, they argue their customers pay within 53 days. That's not what was happening with Lucent. They insist their tech is still a generation ahead.
It's a high-stakes battle of narratives, for sure. Let's quickly shift to some corporate earnings and policy stuff, because it reflects these bigger trends. We're seeing a real split in the tech sector on AI profitability.
We are. On the hardware side, Dell is flying. Their shares rose after they raised their 2026 AI server revenue forecast from $20 billion up to $25 billion. That just shows the demand for the hardware, the infrastructure, is still accelerating.
But then you look at software, and the cost of playing in this space becomes really clear. Workday shares slipped, even though they beat expectations. The problem was their profit margin guidance was just slightly below what analysts wanted.
Just a hair below, and the stock gets punished. And you see the spending crunch most clearly with Alibaba.
Yeah.
Their cloud revenue jumped a strong 34%. Great. But a key profitability measure, adjusted EBITDA, fell 78%.
70%.
Yeah. Dragged down by massive spending on AI and commerce, it just shows how expensive this race is, even for a giant like Alibaba.
And moving to policy, we should keep an eye on the UK. They're preparing for the autumn budget, and analysts are expecting a smorgasbord of tax hikes from the finance minister.
Meanwhile, stateside, we have chaos brewing over the new U.S. tax relief measures. The IRS just released guidance for President Trump's temporary deductions for tip and overtime pay.
The idea is to give a break to lower and middle-income workers, but the execution sounds messy.
Extremely messy. The IRS is encouraging employers to provide reporting for 2025, but it isn't mandatory for that first year. So tax experts are warning that taxpayer confusion will be off the charts.
Because the worker won't have the paperwork they need to claim the deduction.
They won't have the source document. It puts the burden of proof on them and makes accurate filing almost impossible for millions of people.
And briefly on trade, we saw President Trump say he and Xi Jinping pretty much agreed to expand agricultural purchases. A bit of a truce there.
A temporary truce.
Oh.
And more strategically, the administration is negotiating a trade deal with Taiwan. It would include fresh investment and training U.S. workers in chip manufacturing. A clear response to the competitive pressures we were just talking about.
Let's end by looking at the auto industry, because we see two totally different ways of navigating this political market. Tesla and Toyota.
And Tesla is definitely struggling globally. European sales fell almost 50% in October. That's tied to competition, but also some of the political backlash against Elon Musk.
And China isn't looking good either.
No, sales dropped almost 36% in October. They're facing fierce competition from Chinese brands like BYD and Xiaomi. Overall, global deliveries are expected to decline 7% this year. The brand seems to be losing its shine.
Now, contrast that with what Yahoo Finance called Toyota's recent political masterclass. The chairman, Akio Toyoda, showed up at a NASCAR event wearing a MAGA hat and then announced a $10 billion U.S. investment plan.
This is a textbook example of political risk management. Analysts see it as a strategic move. By announcing this big investment, Toyota hands President Trump a public win.
And that keeps the administration happy ahead of the big USMCA trade agreement review in 2026.
Exactly. It's an explicit effort to manage trade risk with very visible political gestures. It's something Tesla, given its CEO, seems unable to do right now.
So bringing it all together, the central tension for global markets is clear. Stocks are rising on this strong expectation of lower U.S. rates driven by politics. But at the same time, Japan is moving toward tightening, and the all-important AI sector is battling competition and some really serious accounting questions.
Which leads us to the final thought for you to chew on. Given that the Bank of Japan is worried about the weak yen causing inflation, forcing them to raise rates, while the new Fed leadership is expected to favor aggressive cuts, how will this growing policy gap between Japan and America affect global currency and trade flows in the next year? That divergence is widening every day, and something has to give between the dollar and the yen.
We'll see you all tomorrow morning with new headlines from major financial magazines.